If you have ever been confused by bonds, then I'm here in this video to clear up all of your doubts about bonds. We're going to go from the initial entry of a bond all the way through to the very end of the bond, talking about all of the essential journal entries. So let's jump in.
So now let's ask, what happens throughout the life of a bond? There are two events happening. One is we, the sellers of the bond, make interest payments to the owners of the bond. Two is we pay the face value of the bond to the owners at the end of the bond. So let's consider this example. We issue a bond with a face value of $100,000. The stated rate is 10%. The bond matures in 3 years. So then each year we're going to make interest payments to the owners of the bonds. We're going to pay them $10,000 each year, which is the $100,000 face value times the stated rate of 10%. And at the end of the 3 years, we're going to pay the entire face value of $100,000 to the owners of the bonds. So then by the end of the bond, the owners have received $130,000 cash, $30,000 in interest, and $100,000 face value, when their investment was only $100,000. Now let's go through the journal entries throughout the life of this bond. So initially, we, the seller of the bond, issue the bonds. So we receive the cash proceeds, and we record bond payable for the face value of the bond for $100,000. Then each year we're going to make interest payments. We find the amount by taking the face value times the stated rate, debit to interest expense, credit to cash. So then at the end of the bond, we're going to pay back the face value. So then we're going to debit bond payable and credit cash. So as you can see, this is really like a loan agreement. We're borrowing an amount, paying interest on it, and then paying back the amount at the end. So this is how a bond works. So now let's talk about bond terms. So the company that issues the bond is known as the seller of the bond. So they are debiting cash and crediting bond payable. The individual that invests in the company's bond is the buyer of the bond. So they credit cash and debit bond receivable. So what is the stated interest rate? This is the rate that determines the cash payment that a bond requires. So our cash interest payment each year is going to be the stated rate times the face value of the bond. What is the effective interest rate? This is the rate used to calculate the present value of the bond and to calculate the interest expense. This is the percentage return for a similar investment. Sometimes this is known as the market rate or yield to maturity. What is the face value of a bond? This is the amount the company issuing the bond must pay to the bondholders at the end of the bond's life. So it's the amount that we record as bond payable at the issuance of the bond. It's also used to calculate the bond's cash interest payments because the face value times the stated interest rate is the cash interest payment. So what is a bond discount? A discount causes the price of a bond to be lower than its face value. A discount is always caused by the effective rate being higher than the stated rate. A discount is going to be a debit entry from the seller's perspective. Make sure you memorize that. And a bond discount causes the interest expense to be more than the cash paid. So then a bond premium is going to be the opposite of a bond discount. So it causes the price to be higher than the face value. It's caused by the effective rate being lower than the stated rate. A premium is always a credit entry from the seller's perspective, and it's going to cause interest expense to be less than the cash paid. So then what is the carrying value of the bond? This is the amount the bond shows up for on the balance sheet. If you have a discount, it's the face value minus the discount. If you have a premium, it's the face value plus the premium. So the carrying value is going to change each year due to the amortization of the discounts and the premiums. Now let's talk about present value terms for bonds. So remember that a bond is a combination of interest payments and the face value repayment at the end of the bond's life. So for the interest payments, to find the present value, we're going to either use ordinary annuity or annuity due. For the face value repayment, we're going to use lump sum. So an ordinary annuity is an annual payment made at the end of the year. So for example, a bond is taken out on January 1st and the payment will be due December 31st. So an entire year passes. An annuity due is an annual payment made at the beginning of the year. So a bond is taken out on January 1st when it also makes its first payment. So these are the two options for the present value of the interest payments. Then we have a lump sum, which is the present value of one sum of money after a certain number of years, which is for the payment of the face value at the end of the bond's life. So we're going to have to find the present value of this face value repayment. So now let's consider an example of a bond with a discount. So we issue a bond with a $200,000 face value. It's a 5-year bond paid annually. The stated rate is 5% and the effective rate is 6%. So what does it mean that the stated rate is 5% when the effective rate is 6%? It means the bond is going to pay 5% in interest, whereas the average rate for bonds is 6%. So the effective rate is the average rate for other bonds. So then the question might be, why would anyone want to buy this 5% bond when they could buy another 6% bond? And here's the key to discounts. Because the company issuing the 5% bond is going to issue it at a discount. So in this example, the price of the bond is $191,575. So in other words, the investor is going to buy this bond for only this amount, yet when it matures in 5 years, the company is going to pay them the full $200,000 face value. Therefore, this extra $8,425 is the company incentivizing them to purchase this bond that pays less in interest payments than the bond market. So that's why we have a bond discount. So let's ask, what would be the initial journal entry for issuing this bond with a discount? This is from the seller's perspective. So we're going to receive the cash for the price of the bond. So a debit to cash for $191,575. The bond payable is always going to be for the face value because that's what we have to pay back at the end of the bond. And the discount is going to be the difference between the two. So it's the difference between the bond payable, the face value, and the price of the bond. And a discount is always going to be a debit. So think of the D in discount for D for debit. So now let's consider this bond example for a premium. Now remember that a premium is the opposite of a discount. So a discount causes the price to be below the face value, and a premium causes it to be above the face value. So let's consider this example. The bond is going to pay 5% in interest payments, and a similar bond would pay 3%. So then why would someone buy a 3% bond when this bond offers 5%? The reason is because the bond paying 5% is going to cost more, because the company is going to issue it at a premium for the better interest payments. So the price of this bond is going to be $218,319. So this means that the investors are going to buy this bond for $218,319. Yet when it matures in 5 years, the company is only going to pay them $200,000. So the investor pays an extra $18,319 because this bond will pay better interest payments than the bond market. So this is how premiums work. So now let's look at the journal entry for initially issuing this bond from the seller's perspective. So the seller is going to receive this amount of cash at the issuance. The bond payable is still going to be for the face value of the bond because we only have to pay back $200,000. And the premium is going to be the difference between the two. So premium is always a credit. So now let's talk about how we find the price of a bond. So the value of a bond is based on the present value of two elements. The present value of the face value of the bond, which is a lump sum, and the present value of the bond interest payments, which is an annuity. So let's consider this example here. And let's solve the present value with Excel. So here are the formulas for you to see. So first we have the present value of the face value of the bond. So we're going to have a $200,000 amount after 5 years at a 3% rate. So we are always going to use the effective rate for the present value, always. Then we have to calculate the present value of the bond interest payments. So the interest payment is going to be the 5% stated rate times the $200,000 face value. So each year we're going to make a payment of $10,000 and we have a rate of 3%. So then this is the present value. So we add up both amounts to get to the price of the bond. So I wanted to show this to you in Excel to help you conceptually understand the concepts and maybe practice them, but here's the way that a CPA question would present the information. It would say a present value of a lump sum for 5 years, 3%, 0.863. So then for the present value of the face value of the bond, we would take the 200,000 times 0.863. Then we have a present value of an ordinary annuity for 5 years at 3%. So we have to multiply the annual payment by this factor. So the annual payment is 10,000 and we have this factor of 4.580. So we add up both items to get to the price of the bond. So here are the important bond formulas that you need to know. Interest expense is the effective rate times the carrying value of the bond. Cash paid is the stated rate times the face value. Amortization is the interest expense minus the cash paid, and the initial bond value or price is the face value plus a premium or face value minus a discount. So the good news is if you can master these formulas, then you can master bonds. So for your next practice questions, try implementing all of these different formulas. So now let's consider a bond example and go through all the journal entries throughout its entire life. We issue a bond with a 200,000 face value for a price of 191,575. So we will have a discount. It's a 5-year bond paid annually, 5% stated rate to determine the interest payments, and 6% effective rate to determine the present value. So then what's the entry at the issuance of the bond? So we, the seller, receive the cash proceeds. We have a bond payable for the full face value of the bond, and the discount is for the difference between the two, 8,425. So then our carrying value at issuance is the bond payable minus the discount, which is the same as the cash proceeds. So then what's the journal entry after 1 year of the bond? So we need to debit interest expense for the carrying value times the effective interest rate. So we're going to record this amount of interest expense. We're going to make a cash payment of the stated rate times the face value, and we're going to amortize the discount for the difference between the two. So this number and this number are going to change each year. So we write off this amount of the discount, so then our remaining discount after year 1 is only 6,930. So then our discount was initially 8,425, but then we wrote off 1,495. Therefore, the remaining discount after year 1 is this amount. So then the carrying value after the year 1 payment is 193.70. In other words, it has increased. And the reason is because the discount initially decreases the carrying value. So as we write off the discount, the carrying value is going to get closer and closer to the face value of 200,000. So now what would the journal entry be for the year 2 interest payment? So for the interest expense, we take the end of year 1 carrying value, multiply it by the effective rate. We still pay the same amount of cash, and now we discount the difference. So we are discounting an increasing amount each period. Therefore, the carrying value increases after year 2 up to 194,654. So then at the end of year 3, we're going to have this journal entry. We have interest expense for the carrying value at the end of year 2 times the effective rate. The cash is still the same. So because the interest expense is increasing each year, the amortization of the discount is increasing each year. Therefore, the carrying value after the year 3 payment is 196,333. So what would the journal entry be for the year 4 payment? Our interest expense is the carrying value at the end of year 3 times the effective rate. So then we have a carrying value of 198,113 at the end of year 4. And then for year 5, we're going to have this interest expense, and we're going to amortize this amount of the discount. So by the end of year 5, we have amortized the entire amount of the discount. So then the carrying value after the year 5 payment is going to be 200,000. So now we are at the end of year 5, the end of the bond's life, and the carrying value is back to 200,000. Now we simply make the payment of the face value. So we're going to credit cash for the face value and debit the bond payable. So now all of the balances from the bond are fully off the books. So now let's consider everything that happened throughout this bond's life. We had a face value of 200,000, a price of 191,575, so we had this discount. Then throughout the life of the bond, we amortized the discount by crediting discount and debiting interest expense. and we made $50,000 of cash payments. So our total interest expense is $58,425. So we can see that discounts cause interest expense to be higher than the cash payments, and in the opposite way, premiums cause interest expense to be lower than the cash payments. So now let's consider a very helpful bond formula for quickly figuring out the amortization of the discount or premium. So the formula is the carrying value of the bond times the effective interest rate is going to equal interest expense, and then interest expense minus the cash interest payment is going to be the amortization. So with our bond, for year one, we had this carrying value that we multiplied by 6% for this interest expense. We then credited cash of $10,000, so then we amortized the difference. So this is useful for filling out for any bond problems that you do. So you can see that throughout the bond, the carrying value was increasing, and that's because we were amortizing the discount, so we were going closer and closer to $200,000. We can also see that the interest expense was higher than the cash interest payments because this is the total amortization of the discount. So next time you practice bonds, I would encourage you to fill out this entire table for the life of the bond.